Hello and welcome to the Center for Services Leadership webcast, Managing the Customer Portfolio to Improve Service and Financial Performance. My name is Darima Fotheringham and I'm a Thought Leadership Project Manager at the Center for Services Leadership. To find out more about the Center, visit our website, wpcarey.asu.edu/CSL. And we have two excellent speakers today. I'm joined by Beth Walker and Crina Tarasi. Beth Walker is the Department Chair for the W.P. Carey Department of Marketing and the AT&T Professor of Services Marketing and Management at Arizona State University. Beth is a recipient of a number of prestigious awards for her scholarly research and teaching excellence. Her research interests are centered on cross-functional working relationships and the development of marketing strategy, and on isolating the characteristics of high-performance account managers. She's a member of the CSL Advisory Board and a member of our Research Faculty Network. Welcome, Beth.
Thank you.
Our second speaker, Crina Tarasi, is the Associate Professor of Marketing in the College of Business at Central Michigan University. Her research interests include reducing risk through marketing actions, particularly on customer portfolio decisions, our today's topic. Welcome, Crina.
Thank you.
Beth and Crina are going to share with us the results of their research on today's topic and will offer useful insights into managing your most important asset, your customers. This presentation is based on two highly recognized papers, Balancing Risk and Return in a Customer Portfolio, which was published in Journal of Marketing and received the Maynard Award for significant contribution to marketing theory and thought. And Relationship Characteristics and Cash Flow Variability, Implications for Satisfaction, Loyalty, and Customer Portfolio Management, published in Journal of Service Research, and featured as a must-read for 2013 by Marketing Science Institute academic trustees. And it is also finalist for the Journal of Service Research Best Article Award for 2013. Congratulations, Beth and Crina.
Thank you.
Thank you.
You will find links to these articles in the webcast notes on our website and the CSL blog. Thank you, Beth and Crina, for being with us today and talking about this really important and very relevant topic. And please, without further ado, take it away.
Well, thank you, Darima. Crina and I are delighted to join you in this conversation about our research. I'd also like to recognize our wonderful co-authors, Ruth Bolton, Mike Hutt, and Anders Gustafsson. They are very important components of the research team and have made many large and significant contributions to our work. So while they're not on this particular webcast, they're major contributors to this work. Generally speaking, our research centers on ways to manage risk or variability in a portfolio of a firm's customers. In overview, both of the papers that you just mentioned highlight the importance of considering the likely variability of revenue streams produced by customers when thinking about who to target with their marketing efforts. In the next 20 minutes or so, Crina and I will talk about this new way of thinking about segmenting markets. To begin, I am sure that many of you are familiar with Jim Cramer and the segment on his program Mad Money called Am I Diversified? In case you're not familiar with this segment, customers call in and describe their personal investment portfolio. Jim Cramer then tells them how they should reallocate their funds to make sure that they are diversified. For instance, a caller might say something like, I hold some Cisco, Oracle, Chico's, John Deere, and some small cap stocks in my portfolio. Am I diversified? Drawing on financial portfolio theory, Cramer might say, okay, you're overweighted in tech stocks, so your portfolio is volatile, it's too risky. What you need is some pharma, some Exxon to smooth things out, and then you'll be diversified. For an investor, financial portfolio theory demonstrates that optimal investment performance can best be achieved by building a diversified mix of investment assets that includes stocks and bonds of large and small firms across industries to maximize investment return for a given level of risk. Although risk management is central to the financial portfolio theory and occupies much of the thinking of a CFO, In marketing, researchers have given little attention to thinking about risk as it relates to market segmentation and to selecting the portfolio of customers that we choose to serve. What happens in current practice is that a portfolio of customers reflects a set of uncoordinated set of decisions that were made in the past that individually each made a lot of sense. Firms tend to pursue customers that promise the highest level of overall return from a revenue and profit point of view, and that makes a lot of sense. However, as noted by Dhar and Glazer in the quote on this particular slide, few companies consider whether all of their individually desirable customers are, from the standpoint of risk, desirable collectively. And that is exactly the issue that we plan to study. On this slide, there's a graph, and I want to just take a few minutes to explain it. This is a graph of 6 clusters of customers. Essentially, think of each of these lines as 6 different market segments that were grouped together based on the level and variability of their cash flow or revenue patterns. So on the x-axis, we have time in months, and on the y-axis, we have level of cash flow in millions. We can think about cash flow as cash receipts minus cash payments. You can think of this also as profit data or revenue data, whatever you have available. So typically, managers in the marketing literature have been interested in the level or amount of cash flow. How high on the y-axis? That's what we've been most centered on. And we go after or we target those firms that are going to be very high on this y-axis. So customer lifetime value, for instance, is a concept that has been very helpful and centers on the customers essentially that will be highest on this y-axis or deliver the most customer lifetime value for a company. But also important is the variability, the ups and the downs of the cash flow stream. So you can see by these different segments, there is some greater variability and less variability. And in our world, variability equals risk. And we simply have not looked as strongly at the implications for variance on cash flow and the implications that variance has for market segmentation. In terms of our goal, we would love high levels of cash flow with low variability. So in our work, what we're trying to do is identify possible ways to reduce variability or risk in cash flows without adversely affecting the level of cash flows. So I hope that makes sense. Let me take you through another example. IBM versus Sun in the late 1990s. And as you know, Sun's been purchased by Oracle. In the late 1990s, during the tech bubble, many firms like Sun overweighted in .com because that's where the growth was happening. So it made a lot of sense. In contrast, IBM was diversified. IBM's portfolio of customers includes large Fortune 500 customers, similar to blue chip stocks, for instance, and the firm derives recurring revenue streams from multi-year outsourcing contracts from other large organizations. These resemble AAA bonds and give IBM some stability in their revenue flows. Likewise, IBM serves a mix of small and medium-sized companies characterized by higher volatility and growth like small cap stocks, as well as a host of international customers. This balanced portfolio has shielded IBM from the severe volatility that has characterized the IT sector during the past decade. Some competitors like Sun, who had or were overweighted in .com companies in the late 1990s, as many might remember, experienced extreme volatility in their earnings when bankruptcy hit many of the startups that provided a dominant source of its revenue. IBM, in contrast, continues to go strong. In fact, one investor said, revenue is not the goal of IBM, and this is on the slide. Its model is about pursuing higher margin, recurring revenue and reducing volatility. Interestingly, in 2010, IBM made the forecast that earnings would grow from $11 to $20 per share by 2015, and this means that this revenue would come from a 5% annual revenue growth and 12% annual earnings growth. And since then, truly, IBM stock prices followed a relatively smooth path, and it's now about from $120 a share to right around $200 a share. So IBM appears to be rewarded by investors because of their approach, really focusing on reducing volatility in their revenue streams. The purpose of our research is to demonstrate how the fundamental tools of analysis that professional investors use in managing the risk and variability of a stock portfolio can be effectively applied to manage a firm's customer portfolio. So we're essentially taking all that theory from finance and applying it to marketing so we can use it to help better segment markets. We have looked at two approaches for managing risk. The first approach is really what we did in our Journal of Services research paper. The question is, are traditional approaches to segmentation, for instance, age and income, linked to cash flow variability? What about relationship characteristics like satisfaction and membership and loyalty programs? Is this related to variability? If we knew the predictors of variability in cash flows, we can then begin to manage it. So in that Journal of Services research paper, we really look at risk from that perspective. What are the customer characteristics that affect or predict variability in cash flow patterns? So that's our first approach. Our second approach appears in our Journal Marketing article. Instead of looking at individual customer segments, we can look at an entire portfolio of a firm's customers, their cash flow levels and variability, and determine if that mix is optimal, and make recommendations about what to add and what to drop to make an overall customer portfolio more efficient. So we are truly looking at combining the customers to create a customer mix that reduces overall variability of a customer portfolio, and identifying some of the ways to combine customers so that in aggregate their cash flow patterns offset each other and there's less volatility overall. To achieve these objectives, we conducted 3 field studies across 3 industries in 3 different countries. And in addition to that, some of this work was done in the B2C context and some in the B2B context. So our first study in the Journal of Services research paper was conducted in the telecommunications industry and also in the financial services industries in Sweden and the Netherlands. And as you can see, there's quite a large sample. Our Journal of Marketing paper was done in the B2B context with a logistics service provider. In all of this, across all of these settings, we had highly competitive markets and the data was really rich. The key to this research is finding data where we have long-term information on revenues and profits in addition to survey data. In the first study, we looked at some very traditional customer characteristics: satisfaction, loyalty, breadth of a relationship with the customer, depth of a relationship with the customer, share of income that consumer spends with a particular service provider. And why we selected these particular variables is because they had been connected in the past to influencing the level of cash flows in previous research. In our research, we wanted to know if these same variables affected the variability or risk associated with cash flows. So we examined the effects of these variables on variability as well as level of cash flows, because once we know the factors that predict or influence cash flows, we can then take action to manage it. In this study, we had many interesting findings. I will highlight some findings that I think are of greatest interest, especially to marketing managers. First of all, one of our findings had to do with the double whammy effect, our first finding, satisfaction. What we found is that satisfied customers are very, very good for business. Satisfied customers increase cash flow levels and at the same time decrease the variability in cash flows, and this occurred across both contexts. So that's very important because managers truly have the tools to influence satisfaction, and our research suggests is that this investment really pays off. Our second finding centers on loyalty programs. Loyalty programs, in contrast, create a sour taste. Consumers who participate in loyalty programs have more variable cash flows, but not higher levels of cash flows. This is very important, but you should know that the loyalty programs that we studied provided economic rewards. As a result, they tend to attract price-sensitive consumers who are not interested in spending more, but saving money. So based on our first finding, we recommend that if you have a loyalty program, it needs to be designed to increase satisfaction. That's really the key. And then finally, we found that programs that increase the number of products held by a customer, cross-selling, have greater variability and also greater levels of cash flow. So the breadth and depth of a customer relationship raises the level of cash flow, but it also raises the level of variability that needs to be managed. To follow up on these findings, we used a simulation to conduct some sensitivity analysis. In the interest of time, I will focus on the results for satisfaction, but you can see some other results here. So what we found is that a 10% increase in satisfaction resulted in a 10% reduction in cash flow variability, and at the same time, a 4% increase in the level of cash flow. This illustrates the double whammy effect. This effect occurred across both contexts. Here it is in the telecommunications services context. And you can see the findings for breadth and depth are also illustrated in these charts. Increases in both result in increases in variability, but also cash flow levels. These findings are quite robust because we find the results in two different data sets, two different industries, two different time periods, with two different types of measurement. So really, this is pretty powerful. Even though we studied this pattern of results in these different contexts, you still need to ask the question, is this finding general in business-to-business contexts? Is this finding generalizable for hedonic products? Does satisfaction work differently? Financial services and telecommunications services are fairly utilitarian. Does this apply to high-growth service settings? So these are questions that can be addressed in future research. But at this point, given what we found, we feel that these results are fairly compelling and very robust. So in summary, the first approach examines some customer and relationship characteristics like satisfaction and loyalty and assesses how they predict both variability and level of cash flow. In the second approach, and this is featured in our Journal of Marketing article, we examine a firm's entire set of customers and determine in aggregate what particular customer portfolio will allow this firm to maximize their levels of cash flow for a given level of risk. We compare the firm's actual portfolio of customers in terms of risk and return to our optimal portfolio based on applying financial principles of diversification, and then suggest strategies for improving the customer mix, kind of like Jim Cramer does, and ultimately performance. So at this point, I'm going to turn it over to Crina, and she can describe the rest of the study. Crina?
Thank you so very much, Beth. So I will start with the same chart that Beth presented at the beginning of the talk, with the fact that we look at customers and their patterns over time, and we noticed that they cluster quite well just based on their variability. So without using any information related to the company size or the industry or the level of sales per se, just looking at the patterns, we noticed that there are customers that group together really well. And we noticed that based on, as you can see on the vertical axis, we have the millions of dollars, and on the horizontal, we have the period of time we were able to measure and look at those customers across 6 years, so 72 periods. And when we looked at the clusters, we noticed that actually, even though we looked just at variability, we had customers within the same clusters sharing industries, share size of the company, sharing similar levels in the sales. For example, you can see on the cluster on the top, which is cluster 5, that had peaks in November, followed by even bigger peaks in December. So those were actually a number of retailers. And then we had another cluster that was actually heavy on manufacturers, and other clusters that were containing much smaller companies. So we looked at those clusters and their individual variability, and the natural question was, can we combine those clusters of customers in a way that would reduce variability? And can you go a step farther in actually building an efficient frontier? Can we do that for customers? And it turns out that yes, it is possible to build an efficient frontier for customers. And an efficient frontier is characterized, but what are the combinations of customers that will result in the lowest variability for the highest return, or the highest return for the lowest variability? And as you can see on this chart, we have on the vertical the return, and on the horizontal the variance. And we built the efficient portfolio, portfolios E1, 3, 10, and then we compare that with the current portfolio, and we've noticed that there is quite a bit of difference. And why is that difference? Well, there might be several reasons. For example, the company is not trying to reduce variability because they don't know how. And the second reason might be that even if we know what is ideal, it might be too expensive, or it might be too impossible to find many customers within the same cluster. There might be other limitations. But however, knowing what the ideal is, we could move in that direction. So, for example, the current portfolio has 2 clusters that dominate, cluster 1 and cluster 5, and the other clusters are rather small. But the ideal portfolio, we notice that has a very different presence of the clusters of customers. It is indeed the efficient portfolio, it is indeed more balanced. Cluster 1 and cluster 5 don't dominate it quite as much, and we see an increased presence for clusters 2, 3, and 4, and for the portfolio that was actually with high variability and without much return, that cluster actually got reduced to 0. How is it useful to know what the efficient portfolio is when we probably are not able to make such drastic movements toward obtaining the ideal portfolio? Well, when we know what the ideal portfolio is, even moving towards that direction can result in lowering variability. And to test our hypothesis, we actually took each efficient portfolio portfolios that we have identified, and we tested it backwards and forwards through simulation to see whether will that portfolio behave in a way that would be favorable to the firm across the years or not. And we built a portfolio for each of the years that we had available. We built one for the year 2001, 2002, and so forth. And the one that you have here is 2006, because 2006 was the most recent year that we had before the test year, which was 2007, and that was the portfolio that the company was going to implement at the time to see whether indeed it would perform well in the future and in the past. And as you can see through back testing, in the upper chart, you have the current portfolio compared with the efficient portfolio on overall profitability. And as you can see, they are very, very close together. In the lower chart, we have the variability of the profit for the same years. And as you can see, the efficient portfolio, the red line, is much more consistent on variability and much lower as compared to the current portfolio. And what are the benefits of having lower variability without losing on profitability? Well, companies can plan much better for their future. They can plan on how to serve their customers in a better way. They can plan their resources, and they can count on those revenue streams without worrying about how much they will fluctuate from one year to another, from one season to another. So as a result of those findings, now it's time to ask, okay, how do I recognize what customers should we add to our portfolio? Is there a way to know that before actually investing in those customers, or when we make our customer investment decisions? And there are two measures that we are proposing, again based on the financial theory, and one of them is customer beta. Customer beta is the degree to which an individual customer contributes to the risk of the entire portfolio. So we are basically looking at the correlation of the customer with the correlation of the overall customer portfolio, and we can decide whether that customer is going to increase or decrease our variability. Again, we do not propose these measures to be looked at them individually, but to be looked at them in conjunction with other measures that we already have. So we don't give away profitability, but we look at both profitability and the variability and other characteristics that make a customer desirable to invest in. The other measure that we propose is the customer reward ratio, the rate of return on risk. In other words, we look at the variability that a customer will bring to the portfolio, and we'll compare that with the return the customers are bringing in. And then we know whether we should take a risk on that customer or not. Is the return promised higher than the variability that they are bringing in? And then we can compare customers with similar characteristics, with similar profitability, and make a decision which one would be the customers that we should focus most of our resources on. Because, right, if we could acquire all customers and it will be as easy to acquire all of them, the decisions would be easy. But we know that it's not as easy to make those decisions on whom should we invest in a world when our resources are limited, as is the situation of most companies. Our key insights for practice center around tools for companies to use in order to reduce the variability in their customer portfolio. So one set of indicators that they could use is the customer beta and the customer reward ratio, which, again, we do not propose them as individual tools, but the tools that complement a marketer's tool belt. Another contribution that we can see is that the firms can layer this information over their existing market segmentation descriptors without much burden on the system that they currently have in place. Another insight is that companies can also use their current tools, right? Like, okay, we should invest in increasing satisfaction. We should invest in increasing the breadth of our relationship with the customer or cross-selling. But then when we make those decisions, we have a better understanding of what the effect will be. What we think that is highly exciting about this kind of research is that we use data that is available to most companies. Purchase transactions, revenues or profitability over time, and firmographics that firms have readily available. Thank you so very much. Now I will turn it back to Darima.
Thank you so much, Beth and Crina. Thank you so much for sharing your time and expertise today on this really interesting and exciting topic. I know that a lot of companies will find it very useful. And thank you, everyone, for listening. If you have any questions or comments about the presentation, we'd love to hear from you. You can submit your feedback on our blog or by email. And we'd love to connect with you through social media and hear what you think about this and other content that we've shared. Thank you again for listening, and thank you again, Beth and Crina.
Thank you.
Goodbye.